Voodoo. 1. Welcome. Capital market meaning, function. Definition. The capital market is a financial market where individuals and institutions buy and sell financial securities. It plays a crucial role in channeling savings into investments, thereby promoting economic growth. Role. Capital markets provide a platform for companies and governments to raise capital by issuing stocks and bonds. They also offer investors the opportunity to buy and sell these securities. Example. Case study. The IPO of a technology startup on a stock exchange. The company issues shares to the public to raise capital for expansion, while investors buy these shares in the hope of future profits. 2. Major market segments and types of instruments. Definition. Capital markets are divided into major segments: equity markets, for stocks; debt markets, for bonds; and derivatives markets, for contracts based on underlying assets. Role. These segments cater to different investment needs. Equity markets offer ownership stakes, debt markets provide fixed income, and derivatives markets offer risk management tools. Example. Case study. A diversified investment portfolio may include stocks for growth, bonds for income, and options for hedging against market volatility. 3. Economic functions of capital markets. Definition. Capital markets allocate financial resources by connecting savers and borrowers. They foster economic growth by funding innovation and entrepreneurship. They also facilitate risk management. Role. Capital markets enable companies to raise capital, which stimulates economic activity and job creation. Investors can diversify their portfolios, reducing risk. Example. Case study. A government issues bonds to fund infrastructure projects. Investors buy these bonds, and the funds are used for building roads and bridges, boosting the economy. 4. Securities markets and important market participants. Definition. Securities markets are where financial instruments are bought and sold. Key participants include investors, brokers, exchanges, and regulators. Role. Investors provide capital, brokers facilitate transactions, exchanges ensure market efficiency, and regulators maintain market integrity. Example. Case study. A stock exchange like the New York Stock Exchange, NYSE, facilitates the trading of shares in publicly traded companies. 5. Commercial banking and investment banking. Definition. Commercial banks offer traditional banking services like deposits and loans. Investment banks help companies raise capital and provide advisory services. Role. Commercial banks support day-to-day financial needs, while investment banks assist with major financial transactions like mergers and acquisitions. Example. Case study. An investment bank advises a tech company on acquiring a smaller rival, helping it expand its market presence. 6. Primary and secondary markets. Definition. Primary markets involve the issuance of new securities, while secondary markets involve the trading of existing securities. Role. Primary markets help companies raise initial capital, while secondary markets provide liquidity to investors. Example. Case study. An initial public offering, IPO, in the primary market allows a startup to go public, while investors trade those shares on secondary markets afterward. 7. Primary market offerings. Definition. Primary market offerings involve the issuance of new securities to raise capital. This includes IPOs and rights issues. Role. Primary offerings allow companies to access new capital for growth and expansion. Example. Case study. A pharmaceutical company conducts an IPO to raise funds for clinical trials of a groundbreaking drug. 8. Roles of financial intermediaries. Definition. Financial intermediaries, such as banks and brokers, connect savers and borrowers, provide financial services, and manage risk. Role. Banks accept deposits and provide loans, while brokers execute trades on behalf of investors, ensuring efficient markets. Example. Case study. An investor uses a brokerage account to buy shares of a tech company, and the brokerage executes the trade on a stock exchange. 9. Comparing securities to derivatives. Definition. Securities represent ownership, stocks, or debt, bonds, while derivatives derive their value from underlying assets. Role. Securities are traditional investments, while derivatives are used for risk management and speculation. Example. Case study. A farmer uses futures contracts to hedge against fluctuations in crop prices, reducing the risk of financial loss. 10. Introduction to fixed income securities. Definition. Fixed income securities are financial instruments that pay a fixed interest or coupon rate at regular intervals until maturity. They include bonds issued by governments, corporations, and other entities. Role. Fixed income securities offer investors a stable income stream and are considered less volatile than stocks. They are commonly used for income generation and portfolio diversification. Example. Case study. An investor purchases a 10-year corporate bond with a 5% annual coupon rate. They receive $500 in interest income each year until the bond matures, providing a predictable cash flow.